A currency can win the night and lose the morning, and that is precisely what sterling has just done. On Thursday, July 30th, 2026, the pound is handing back gains it made only hours earlier, and FX Street put it perfectly: the pound rented a rally it has to pay for in the morning. A rented rally is not an owned one. It is borrowed from a single catalyst, propped up by short-term positioning, and repaid the moment London traders take charge of the order book. Overnight, GBP against the dollar pushed higher in the thin hours of the Asian session. By the early European morning it was described as meeting fresh supply, which is the polite market term for sellers waiting patiently at higher prices. Nothing about Britain's underlying economic story changed between those two moments. What changed was who was trading, how much liquidity existed, and whether anyone was willing to pay up at the highs. Check your screen only twice and the pound looks strong. Watch the intraday pattern and you see something far more fragile. Here is the mechanic that most retail traders miss. Pound sterling to US dollar is not one price, it is two currencies fighting, and the pound often gets credit for moves it did not earn. When the dollar softens after a central bank event, every major currency rises against it, sterling included. That looks like pound strength on a single chart, but it is dollar weakness wearing a Union Jack. The professional test is simple and free: look at the pound against the euro. If sterling is genuinely in demand, euro to pound sterling falls at the same time pound sterling to US dollar rises, because the pound is beating both currencies. If euro to pound sterling barely moves, the rally was rented from the dollar and will be repaid whenever the dollar recovers. Thin overnight liquidity makes the illusion worse. In the Asian hours there is almost no UK news flow and far fewer participants, so relatively small orders can drag price a long way. The rally is real on the chart, but the conviction behind it is borrowed. The catalyst arrived on Wednesday, July 29, 2026, when the Federal Reserve wrapped up its two-day meeting that began on the 28th. Fed decisions land at 7 o'clock in the evening UK time, which is exactly when the first sterling headlines about a rally started appearing. That timing is not a coincidence, it is the whole story. Currency markets have a well-documented habit around central bank events: an immediate, mechanical reaction to the headline, followed by a slower, more considered reassessment once traders read the full statement, digest the press conference and compare it with what was already priced into interest rate futures. The first move is emotion and algorithms. The second is analysis. Very often they point in opposite directions, and the reversal frequently arrives during the next London morning, when the deepest pool of currency liquidity in the world reopens. Sterling did not stumble because Britain disappointed overnight. It stumbled because the dollar's initial reaction was overdone and London simply repriced it. There is a second force at work today that has nothing to do with opinions about the pound. Friday, July 31st, 2026 is month end, which makes this week one of the most flow-driven of the month. Global fund managers who hold overseas assets must rebalance their currency hedges as those asset values change, and the vast majority of that business is executed at the WM Reuters benchmark, set at 4 o'clock in the London afternoon. That single window can push a currency several tenths of a percent in minutes for reasons that are purely administrative. Add the daily options expiry at 10 in the morning New York time, where large strike levels act like magnets, and you have two mechanical events that regularly override fundamental logic. Layer on the summer factor: as August approaches, senior traders go on leave, order books thin out and the same trade moves price further. Today's pound action is therefore part economics and part plumbing, and the plumbing is currently loud. Zoom out and there is a structural reason the pound struggles to hold on to good days. Britain runs a persistent current account deficit, which means the country imports more value than it exports and must attract foreign capital every single day to balance the books. That dependence on what a former Bank of England governor famously called the kindness of strangers ties sterling tightly to the gilt market and to investor confidence in UK public finances. When gilt yields rise because investors doubt the fiscal path rather than because growth is improving, the pound tends to fall alongside them, which is the opposite of the textbook relationship. That question has hung over sterling since the autumn budget of November 26, 2025, and it will return with force as the next budget approaches, along with speculation about how much headroom the Chancellor really has against her own fiscal rules. Meanwhile, the Bank of England has been easing gradually while services inflation and pay growth stay stickier than goods prices, leaving rate expectations genuinely two-sided. This is not an abstract chart argument, it reaches your wallet in three ways. First, holiday money. Late July and August are peak travel weeks, and an intraday swing of 0.5% is roughly £5 on every 1,000 you convert. Because airport bureaus and app-based providers update their rates with a lag and a margin, a rented rally rarely reaches consumers before it disappears, so buying on a headline spike is usually a mistake. Second, import costs. Britain imports most of its food and effectively all of its crude oil pricing in dollars, so a weaker pound feeds through to fuel and supermarket prices with a lag of weeks, not days. Third, your pension and ISA. Roughly 3/4 of FTSE 100 revenue is earned outside the UK, so when sterling falls, the sterling value of those overseas earnings rises and the index often gains. That is why the pound and the FTSE frequently move in opposite directions on days like today. Near term, the pound's direction rests on a short and specific calendar rather than on sentiment. The Bank of England's next scheduled policy decision falls in the first week of August, and with the vote split expected to stay narrow, the accompanying language on services inflation matters more than the decision itself. Then comes the United States jobs report on Friday, July 8, 2026, the single largest scheduled driver of the dollar, followed by UK inflation and monthly growth figures in the middle of August. Between those dates, expect exactly the pattern seen today, catalyst-driven pops in thin hours that fade when real volume arrives. The practical signal to watch is not the pound sterling to US dollar headline but whether the pound can gain against the euro at the same time. Until it does, treat rallies as rentals with a short lease. And remember that August liquidity is the thinnest of the year, which exaggerates both directions and punishes oversized positions. So the lesson from Thursday, July 30th, 2026 is worth more than any price forecast. When you see a headline saying the pound has rallied, ask three questions. Was the move driven by British news or by the dollar's reaction to the Federal Reserve on July 29, 2026? Did it happen in deep London hours or in the thin overnight session? And did sterling also gain against the euro? If the answers point outward rather than inward, the rally is rented, and rent always falls due. That is not pessimism about Britain, it is simply an accurate reading of how a currency that depends on foreign capital behaves in a low liquidity, month-end, mid-summer market. Traders who understand the difference stop chasing the spike and start watching the fade. If this breakdown helped you read the pound more clearly, subscribe for daily UK market analysis, and tell us in the comments where you think sterling ends the week.